This could easily be the most important video that I've created for financial advisors in the last 10 years. This is going to deal with an issue that is a big problem for most firms, and I'll define it in a minute, what type of firms. But I will say, because I do research on our industry, I do research on what affluent ideal clients are looking for in a financial advisory firm. I do extensive nationwide research on the firms themselves. And I'm a financial advisor, so I'm in a position to know what is interpreted from this research because I ran a multifamily office for 25 years. The problem is in the word plan. Words mean different things to different people. What I'm going to do in this video is I'm going to define the word plan. Not that it doesn't make sense to you already. I'm sure you have a picture in your mind of what you provide in terms of a plan for your clients. But I will tell you that the way clients think of the word plan and how they define it is completely and utterly disconnected from what the industry thinks of typically as a plan. I say this because I'm looking at data. 82% of clients confirm that they have never received what they would define as a plan. The research focused on multimillionaires. So regardless of what kind of planning firm you've got, and it doesn't matter if the service that you're providing is something a little bit different than planning. There are a lot of firms out there that provide services like investment management or tax services or estate planning, and you provide planning incidental to your services. This is a very common model. You may not define your firm as a planning firm, but the minute you hold yourself out to a client saying, I'm going to provide a plan for you, what the client has in mind and what the industry has in mind is different 82% of the time. The objective of a business is to serve clients. If you are serving clients in a way that frustrates them or doesn't meet their expectations, forget exceeding their expectations, which is the standard that we insist on at our firm and the standard on which I do most of these videos for high-end financial advisors. It should be all about exceeding expectations of ideal clients. That's so that your firm will grow and that your reputation will help drive clients to your firm because you exceed expectations. But if you can't meet the minimum expectations of a client, or if just the definition in your head of what you think you're providing and what you're willing to provide is so different and so much below the client standards that it's actually harming your reputation, that's worth paying attention to. This video, I'm going to define the word plan by taking the data, and I've got a lot of client data on how they define plan, and you need to assess what you provide to clients against this definition. The goal of this video, at the end of the video, you're going to have a 3-point checklist to look at the work product that you create for clients and give to them that would be described as a plan. So what are the 3 items on the checklist? The framework for you to think of a plan, the way the client thinks of it, is this 3-point checklist. First of all, a plan is future focused. It's not about the here and now necessarily. It's not just defining how the client situation is currently. For example, a balance sheet showing where everything is right now in terms of assets and liabilities. And on the investment side, it's not just simply a pie chart showing allocation of assets in various asset classes. That's a picture of where the client is now. A plan is future focused. I'll agree with you that the plan needs to clearly define where the client is now versus where they want to be in the future, but the plan is the roadmap to that. So it's future focused. A plan includes a plan of action, which is to say the action steps required to implement the plan. And the third element is a plan in the mind of a client is a playbook. By playbook, what the client is thinking is if things don't unfold perfectly as expected, there is a playbook for alternate scenarios, that if something happens that's not just perfectly the way we expect it, that there is, in essence, a plan B and a plan C, that we've got a playbook to jig and jag when the markets or the world events or headlines require things to change. Let me go through them one at a time, and let's see if the work product that you and your team are creating, the thing that you have shared with clients, and I'm not talking about just performance art, like not just explaining it to the client in a meeting, which is a personality-based system where you have a plan and the way you convey it to the client is verbally. I will agree that many advisors actually do a pretty good job of that and have great strategies and have a playbook, all these things that I'm just describing. But in the mind of a client, what the client expects is that all of that is documented, that there is in the file somewhere for their entire team a document that lays all this out. I'll go through each of the steps, but I want you to think of what the way the client is thinking of this. What they're thinking is, if they asked you, can I see the plan that I'm paying you to create for me? That you would be able to give them a document that they could, hypothetically, they could hand it to their accountant, or they could hand your plan to their estate planning lawyer, who could read it without you being there to explain it to them. It's clear. It's clear what's going to happen in the future to achieve the client's objective. Let's take it step by step, one at a time. I'm telling you, if you can deliver on this word, plan, for an affluent ideal client family, and you deliver something that meets this definition, you've already exceeded the service level of 82% of advisors in the English-speaking world, because multimillionaires confirm, 82% of them confirm, they've never seen anything what meets the definition that I'm about to lay out for you. I will also say that what the client's asking for and what they're envisioning is quite reasonable. It's quite doable on your part, and it's a high payoff activity, because advisors who can meet this definition of creating and delivering a plan for the client can charge substantially higher fees. I've been mentoring advisors since 2002. I am a financial advisor. I can tell you the data that we've monitored over the years, that when an advisor goes from having a plan but not documented to having a plan that meets this definition, and they could deliver it to the client and the client's financial team, you can 10x your fee. Most advisors increase their fee, or can increase their fee 10x over what they were charging before, after they meet this definition of a plan. Let's take them one by one. Future focused. A plan is a roadmap in the client's mind. It's a roadmap that clearly shows how we're going to get from where the client is right now to where the client wants to be. How do you create that roadmap? The first step is to, in the plan, clearly state the objectives of the client. I would say start small. Figure out the number one objective that the client feels is the most important objective, an objective being something that involves money and planning to achieve. A future-focused event, something that is not currently in existence. You can't have a client saying, oh, I've got ample money, I can do everything I want to do with what I've got. That's a client with no plan. I've done other videos on this. I think that's not a good service to provide, which is just to manage the status quo. I'll say it another way. If in your mind a client has no goals, which I hear a lot, it's almost always because you've failed to probe the client deeply enough about what they hope to accomplish financially before their end of their life. I don't really accept that any client has no goals. I don't buy it. But that's not what this video is about. This video assumes that you have a client who's shared with you something that they would like to achieve in the future, something that does not exist currently, but that they would like to achieve. So the elements of a goal are the name of the goal, could be financial independence. A target date, what date would you like to be financially independent? August 1st, 2032. Okay, that's a date. So we have a name of the goal, we have a target date for the goal. Then the third element is a measurable, a way to measure the goal. This would sound like, what is financial independence to you? How would we know that you're financially independent? And the client has to define this for you, or you can facilitate and help the client define it. But maybe it sounds something like, financial independence for my family would be if we had $25,000 per month coming in on a monthly basis, net after taxes. Okay, so now we have all three elements. We have the name, we have the target date, and we have a measurable. We have something that we can sink our teeth into and create a plan. The first element, it's a future-focused roadmap to an objective. The plan states where we are now and is a roadmap showing clearly, here's how we're going to get from where we are now to this future state. And in other videos, we've talked about this. The client has multiple objectives and not just financial planning objectives. If you're a comprehensive financial advisor, there are objectives in all areas of finance. The question really is, have you identified those objectives for this client, and are they clearly documented in the plan? What are the tax objectives? What are the financial planning objectives we've just been talking about? What are the investment management objectives? What are the estate planning objectives? And so forth. For each area of personal finance, there should be clearly stated objectives, but let's say you're an investment management firm and you provide planning, maybe incidental to your investment management services. When the client says, I'd like a plan, and you say, we do that. We create a plan for our clients. The first check mark is the document that you're creating and providing to the client. Is it a future-focused roadmap showing precisely how you're going to get, for each objective, how to get from where the client is now to where they want to be, which is those three elements defined by each objective. Criteria number 2, plan of action. In addition to what we just described, the second item, the way the client defines the word plan, is that there is a plan of action. Now, that is not just simply, what do I need to do right here, right now, today in this meeting with you to improve my financial situation? If it meets the definition of a plan, the way a client thinks of it, it represents tactics, which are action items, recommendations. So yes, recommendations, but not just for here and now, not just for right here, right now to improve things in the current environment. It's all the actions that will be required to achieve that goal over however many years it takes to reach that target date. A lot of advisors say, but I can't read the future. I'm not a fortune teller. I can't say what needs to happen as far as course corrections 2 years, 3 years, 5 years from now. Depends on how many years until the goal. To which I respond, if you're thinking like a client, I would say, maybe you can't tell the future, but there are some action items that are predictable, identifiable, required by this goal and what this client's trying to achieve. In other words, there are action items that need to be either monitored or taken along the way to achieving each goal. There are things that you know, because you've been doing this a long time, that will need to be either course corrected at some point, or you need to check in with the client to see if there have been any changes in certain aspects of their situation which would require a course correction. At our firm, and what we mentor advisors to implement, is something called the 3-meeting process. This is just the way we do it, and I'm saying this only as a hypothetical so you understand what I'm talking about, but we tell the client that to achieve that goal, we need you to commit to coming into the office 3 times a year, once every 4 months, until you achieve the goal so that we can see what's changed in terms of your situation. We can check in with you, see if things have changed, and we're watching other things. If it's an investment portfolio, we're noticing things are happening in the market, things are reacting to world events. So we're monitoring that, and the client's situation does change from time to time. We tell the client in the plan, we require you to come in every 4 months until the goal is achieved so that we can update the assumptions and make course corrections. And it's as simple as that. So it's either milestones in the future. For example, if you're in an investment management business and a client has a retirement account, there is a date in the future when a client is required to take minimum distributions. That's not something that requires reading the future. That's something built into the law that you know is going to happen. You could put that date when that occurs into the plan if it occurs before the target date for achieving the goal. The second criteria of a plan, the way the client defines it, is that you have a plan of action, which is nothing more than all the tactics required to achieve this goal in chronological order for the client to review. So it's not just what we need to do right here, right now in this meeting with the client. It's every action item or a system that's in place to identify how course corrections are going to be made on the way to the goal. A future-focused roadmap, identifying goals and objectives, and a plan of action, which is clearly explaining how to get from where the client is now to where they want to be with the goal. The third and final criteria that is the minimum definition of a plan, or to say it another way, regardless of what the client has in mind, if you fit these three criteria, then for almost all affluent ideal clients, this would make sense to them and this would fit any reasonable person's definition of a plan. And anything short of these three things represents missing the mark. It is not defined as a plan the way the client thinks of it. And if they were asked by one of their affluent friends, should I hire Mark to do my planning? You don't want the client saying, I've never received anything like that from Mark. By creating this 3-point plan fitting these three criteria, you fit the minimum definition of a plan, and as long as the plan impresses the client, at least it makes sense and fits the criteria of a plan. No longer will they say, I never received anything like that from this firm. They've now received a plan. So the third criteria is the plan needs to have a playbook for alternate ways of accomplishing the objective if things unfold that are unexpected. So this is what I call de-risking the plan, but whatever you call it, once you've got a plan to get the client from where they are now to where they want to be with a goal, it's envisioning what are the likely alternate scenarios that might occur and have a huge negative impact on the plan. I recommend making a list of risks that could face the client that would actually throw the plan into some sort of a alternate scenario. For example, client loses their job, or the client's business goes under, or the client has 12 months of not getting paychecks while they find a new job, or some scenario that you list as being, well, if this happened, that would negatively impact the plan, or if that happened, this would negatively impact the plan. It could be, what if the client's elderly parents broke their hip and got Alzheimer's and they had to start taking time off work to go help the parents, or maybe they need to start pitching in money to help support the parents. My point is, come up with a list of situations that could go wrong and then rank every one of them on two criteria. What's the likelihood of that happening? Because anything could happen. If you're sitting down and brainstorming this accurately, you're going to come up with a lot of things that could happen. I mean, a meteor could hit the earth and we could go into an ice age, but what's the likelihood of that? You're going to list everything that you can think of that would be an alternate scenario. And by the way, if you bring the client in on this thinking, the client will help you out. You just have to ask your client, what could go wrong to derail this plan? And just shut up and listen. Let them tell you this could go wrong and that could go wrong, or I'm on track to becoming partner at the firm. And if that went sideways, then I wouldn't be earning as much. Let the client get involved in this conversation. But once you've got a long list of things that could happen to negatively impact the plan, rank them on likelihood. Now you've got the ones that are highest likely of occurring at the top and going down in priority. Then once you've got them ranked like that, rank them on the scenarios that would have the largest negative impact on the plan. Then based on how likely it is and how much it would negatively impact the plan, pick several and create plan B, plan C, plan D. The idea that you have a playbook that doesn't just envision everything unfolding perfectly, but if this happens, the plan already exists. We just pivot, we switch to plan B, and now that plan is the plan. And we've got a plan in place, even if negative things occur, so that your plan can get back on track and you still accomplish your objectives. It may be that the objectives time frame is adjusted. Maybe they have to push out the date or something of the plan in your plan B, plan C situation. That's not the point. The point is you've got a plan and a playbook to accomplish the goal. You've created a likely case scenario, and you've identified specifically things that could go wrong. And at least for these things, you've created a plan of action for these alternate scenarios. Let me tell you what most firms, or many firms, do instead of this. They run Monte Carlos and they talk about percentages, and the odds that you achieve your goal is you give it a score, 80% or whatever it is. And that is not a client's definition of a plan, because the client's left thinking, well, what if it's the 20% scenario that throws me off the plan? The idea of running a Monte Carlo, it's great, it's fine. I'm not telling you not to do it. What I'm saying is the plan should meet these three criteria. It's future focused, it's a roadmap to achieving objectives that are clearly stated with three elements: a name of the objective, the date objective, and a way to measure success so that you always know whether you're on track or off track to that objective. Let me pause just one final point on that. It's the difference between a goal and objective. I have advisors all the time saying, wait a minute, that's a client goal. That's not an objective. I don't know how you define it, but I can tell you how I define it and how I have my team define it. A goal is an objective. An objective equals a goal. A goal equals an objective. Let's not get caught up in the vernacular, but you can see how words are clumsy. And because the word plan means different things to different people, I think as precise as you can get this, the better. So you have first criteria. You have a future-focused roadmap to get a client from where they are now to the clearly stated objective. And there are many objectives. You have several financial planning objectives or goals. You've got a roadmap for each one of them. Then the second criteria, it's a plan of action. It's not just the roadmap of how we're going to get from here to there. It's a list of action items, tactics. It's a long list of here's what actions need to be taken in chronological order, saying these things need to happen along the way so that we have an actual plan of action to implement this roadmap that we've created for these future-focused objectives or goals. So future-focused roadmap, plan of action, listing tactics in chronological order, all the way out to the target date of the goal. Then finally, a playbook if things go wrong. A playbook that shows it's not just a scoring system of probability. No, we've identified specific things that could go wrong in your situation. And if they have a major impact negatively on your plan, we've thought each one of them through. And now each of these alternate scenarios has a roadmap with a plan of action, so that if something bad happens, and the client will be able to identify that you've honed in on the correct risks that they're up at night worrying about, so that now they have that overwhelming sense of calm, that they have what they define as a plan, and they're happy to sing from the mountaintops to anybody that they want to refer to you that my advisor is better than 82% of every other financial advisory firm out there, in that they hand me something that gets me to my goals, gives me a sense of confidence that we know what we're doing because there's a plan of action and a roadmap and a playbook. If things go wrong, we've got a plan. Finally, we'll close on this one. My advisor updates this thing fully on an annual basis. This is why you're not fortune telling, so that if you lay out all the action items from now to years in the future, when the target date for the goal is achieved, the reason you're not trying to predict the future with your plan of action is because every year you're going to update the plan, which means if something changes, if the rules change, minimum required distributions, anything changes, all those items listed in the plan of action, if things are different this year than they were last year, you will update the plan of action so that it's always current, that every year it's fully updated, and the client not only has confidence that they have a plan that will get them to their goals, even if things go wrong, but that it's going to improve in real time to keep up with the real situation and adjust to real world situations in real time. That's the definition of a plan. If you will start creating something that meets these three criteria, you'll be one of the top advisory firms in your market. The chances are you'll be better than 82% of the other competitors in your market who claim to their clients that they are a planning firm, but without a plan that meets the client's definition. So we'll see you in the next video.